Welcome, welcome. I'm Gabby, Gabriella, Gabs. You can call me anything. I'm the community manager for Cake. I've just joined. Today is my 1 week anniversary, but I'm super happy to have everyone here. First of all, I want to thank you guys for signing up to this event. I know that cap table can be very technical. So, and also thank to David, Nat, and Jason to be here with us. We're gonna just give a couple of minutes for everyone to join. If you want to tell us in the chat where are you from, where you're watching this amazing webinar, please do it. If you have a lot of questions, which you probably do, feel free to pop in the chat along the chat with us. So please, welcome to do so. Yeah, I'm from Sydney, so Vancouver we got here, New Zealand, amazing. Someone is in the car but listening, so really exciting.
Yeah, entrepreneurs are always hustling from the car, from the cafe, anywhere we can, right?
At the gym in Sydney, Northern Beaches. So cool. Gold Coast, Melbourne. Look at that. Singapore.
A couple of Singapore. That's awesome. Cake's being Singapore, UK, India, and the US now. Philippines as well. Awesome.
Yes.
Welcome.
WA. Hi, Ron.
Amazing.
WA. Are you guys your own country yet? Sorry, we don't have to make jokes like that.
Soon. They'll be annexing soon.
Byron Bay, Manly. Amazing, guys.
All the beaches
so cool.
represented. That's good. Bondi.
Yeah, the beaches, Northern Beaches. I'm awesome. Here as well, guys.
Oh, good. I'm over at Queenscliff, so not today.
Oh, that's great. So yeah, David is in Sydney, Nan as well. But Jason is at the moment on the Gold Coast. And yeah, that's really cool, guys. There's so many people there. Well, I'm gonna jump to introductions here. I'm gonna jump to Nan as ladies first, and then eventually Jace and David will introduce themselves. But as I said, feel free, pop your question in the chat during the event, and we're gonna try to answer as much as we can. Enjoy.
Cool, thanks, Gabby. My name is Nan Mika. I'm the head of operations at a Sydney-based local startup called Simply Wall Street, and happy to be here talking about such a cool and sexy topic.
Thanks. Yeah, that's why I have Zoolander up here, Nan. You know, so hot right now. Try and liven things up a bit. Yeah, welcome. Thanks so much for joining. One of my absolute favorite startup people and startups as well. Simply Wall Street, killing it. So congrats on that. And Dave, I'm going to say good day.
Hey, yeah, thanks everyone. So my name is David Kenney. I'm a partner at Hall Chadwick. I specialise in startup advisory. I do a lot of work with helping people go global or raising capital. And we're in for a big treat today because there's lots of good lessons and looking forward to some great chat.
Great work, mate. One of the smartest minds in Aussie startups, in my opinion, and great partner of Cake. So very glad to have you here. Obviously I'm from Cake. Cake's about 3 years old now. We help thousands of companies with their, and obviously one of the more challenging aspects of that is all the different aspects of modeling that you need to do as a startup. So we're really excited to be part of this panel today and share as much as we can. We probably can't cover everything because it's a huge topic and we don't want to kill you with details, but please do hit us with questions and we're going to be around, of course, follow up afterwards. So awesome. So I'll hand over to Nan, who's going to kick us off with a bit of an intro.
Cool. Thanks, Jason. So a good starting point really is to understand what a cap table is. It's effectively a ledger and a snapshot in time. So companies use this to track shareholder equity component of the balance sheet, the securities which it makes up. So you'll see your ordinary shares, your options, your warrants, your preference shares, and the value of the equity effectively. So in order to model future scenarios of your cap table, the current one needs to be up to date and accurate. And setting up a cap table is one of the first things you've got to do as a startup, especially if you're planning to build an investor-backed business and offer employee equity compensation. Next. So founders and investors use cap tables as scorekeeping of significant equity events in their company's history. So there's really three primary reasons. Compliance, of course, which we all love, with ATO and your tax officers and financial authorities like ASIC. And startups also use cap tables as a basis to raise funds and negotiate with potential investors. So this is something that's probably came up with your investors. Your investors are primarily going to be concerned about the ranking of their equities, if there's a liquidation event, and what the dilution looks like in their holdings in future rounds. And finally, as well, cap tables allow you to look at different business choices and how they would affect your capital structure, since this underpins growth and operational plans such as hiring. Any questions around? Yeah.
One thing to add there, which we don't often talk about, there's different types of funding as well. So we've more recently had venture debt come onto the scene as well, and so that's funding that's not going to hit your cap table. So worth bearing that in mind. We're going to talk a lot more about equity style today, because we're talking about the actual cap table, but don't forget that there are those debt options available as well. Shout out to our friends at Tractor and others.
Yeah, cool. And there's quite a few players as well coming up in this space, in the venture debt space, and other funding options as well. So that obviously complicates your cap table a bit more, but gives you a lot more funding options.
Yeah, I remember when I went on to pipe.com, and unfortunately not here in Australia yet, and you fill in this small little wizard and you integrate it with Stripe, and then bam, it tells you how much money you can get like straight away. It was a hell of an exciting moment for a founder. But anyway, we don't have that here in Australia yet, but there are like pretty cool similar alternatives that you can access. So cool. All right, so what's next? Here we've got Zoolander again.
Zoolander repeat again, a bit of blue steel. So when would you model your cap table? So you want to critically analyze capitalization events your startup may face. This helps you to prepare, for funding rounds, helps you to quantify how much equity you can afford to sell and how much your stake will be diluted by. Modeling also helps you to compare different funding offers that you might receive on a like-for-like basis, understand convertible debt, as Jason had just mentioned, such as safes, convertible notes, and their impacts on shares outstanding and share price. Additionally, you can help to monitor your employee option pool headroom and plan allocations accordingly. And finally, when you're planning to sell your company, the exercise helps you to visualize the distribution of proceeds across a range of theoretical exit values, and your real goal is to maximize shareholder returns. Next, please. So there are, next one. Yeah, so this page just kind of shows you the types of models you can run. There are a few types you can run, and David's going to take you through a couple of examples later in the session today. The first one is your round and equity issuance modeling. And so as the name suggests, it just really helps you to map out a number of equity issues during fundraising rounds, from pre-seed to seed to Series A, and helps you keep track of ownership, dilution, and value throughout these whole rounds. The second one we've seen is convertible modeling for safes and notes, which show how the choice of debt to equity conversion methods impact your pre-money or post-money valuation, share price, and share ownership. This analysis gets quite detailed, and quite technical as well, because you can look at other variables such as discount rate, valuation caps, and interest rate impacts on conversions. The third one is option pool modeling, and that shows how the creation of an employee option pool impacts dilution on existing and potential shareholders. You can run this analysis pre or post money valuation to see how that looks, and David's going to address that one as well. And finally, exit waterfalls, which helps you to visualize the distribution of proceeds at exit to different classes of shareholders. And your shareholders have different liquidation preference structures, conversion scenarios, and seniority of different share classes. So it does get a bit complex, but it's good to actually visualize what this looks like.
Might be worthwhile just quickly digging into those waterfalls, Dan, and maybe just talk through a real life example of how that might come about. For argument's sake, you've done a seed round with a preference shareholder with the 1x liquidation, and then you do a Series A again with a a higher level of preference share, again, with a 1x liquidation preference. For those, it is a tricky area, especially for people with a non-finance background. Maybe we could just have a quick jam on that before we move on.
Yeah, absolutely. Sorry?
I said one quick point on that too, Nan, is that one of the other things that I think is important to get at that point at the very beginning is having that conversation with your co-founders about, are you going to have founder vesting? Because one of the very big errors on a cap table is often dead weight, where a founder has got capital and has gone. And if you don't think that can happen to you, it happens to lots of people. And that's also a place that you should be monitoring your capital allocation and who owns and controls your company. So founder vesting, and also just at an overall level, how the speed in which you run your analysis on how you're spending money versus how much your cost of capital is. So your revenue model, comparing that to your cost of capital, is an important tool that should almost be what you use the cap table for as well, in my view.
Yeah, I was looking at, I was listening to the All In podcast, which is one of my new favorites. And they were talking about like the burn rate to the ARR growth rate. So you don't want to be burning more than, twice what you're growing your ARR. So once you know those two numbers, you know how much money you need, then you can sort of back solve that to, what the pre-money, post-money valuation you need, to maintain enough equity in your company. And these numbers are really, really important to keep the growth of your company, the money you're spending, the burn, and the amount of capital, that you're diluting in check from year to year. So yeah, really good point, Dave. Yes. We're gonna touch on that again a couple more times during this, because it's a bugbear of most founders, especially ones that have done a few rounds.
easily missed.
Yeah, nice. Also, back to the waterfall, maybe now, just for a little bit more context on that. Please.
Yeah, we're all chasing waterfalls. That's the ultimate dream, after all. But really,
we should have a soundtrack for that. Isn't there a song about that?
There is, Chasing Waterfalls. I'm not going to sing it. But effectively, it's scenario modeling. So you want to look at what the exit value looks like, and then you want to look at your cap table, and you have ordinary shareholders, you have preference shareholders, and preference are obviously ranking higher than your ordinary. You have convertible notes, so people who do convert from like a debt note effectively to equity, and what they're kind of when they actually convert at a valuation, and what price and what discount they get. So that impacts obviously the exit value that you would get as an ordinary shareholder. The other thing to factor in as well is liquidation preferences. So a lot of VCs put that into the terms of their term sheet, and that impacts the payouts that they get at a certain valuation. And so if a company doesn't reach an exit at a certain valuation, then a clause like a ratchet clause could kick in, and the preferred stock holder would effectively get maybe 2x back, in terms of return, and as an ordinary shareholder, you might get less. So it's really figuring out what scenarios can potentially happen, and then looking at what that means for your ordinary stock. As a founder, you primarily do hold ordinary stock. Your employees also hold ordinary stock. So it's really important for you to understand what that dilution looks like at an exit.
Awesome. Thanks. I've had a couple of other questions, but I think we've been solving those in the chat. Do we need beta testers for any cake modeling tools? Yes, please let us know. We will be sharing templates at the end. Nan's got a couple of templates that she uses that are sort of open source, and Dave and myself, so Cake and Hall Chadwick, have been working on some templates and tools as well. So we'll share details of those with you at the end. Awesome. A few people keen to get involved. Thank you. That's great. All right. So ticking along, doing pretty well for time.
Cool.
What have we got here?
Yeah, so this is I don't know if anyone's seen The Social Network. Great movie, along with, Silicon Valley, the TV show, on what not to do and what to avoid. A lot of learnings from there. So as a founder, of the startup, the goal of doing this whole cap modeling exercise is to help you make informed decisions on what external money you want to take. you want to ultimately maximize the amount of capital and minimize dilution so you can create a worthwhile payout upon exit for yourself and your early backers. That's why you're in this. There's a scene in the movie called The Social Network between Zuckerberg and his Facebook co-founder, Eduardo Saverin. It addresses the changes in the Facebook cap table and resulting impact on Eduardo's percentage ownership due to dilution or following funding rounds. So question to you guys, if he had done some cap table modeling, do you think he could have renegotiated his terms?
I reckon he could have.
Yeah.
Yeah. Anything can happen in the real world. You just got to be.
There's always a new clause that can be added. Yeah. So
can depend on the cap table. Quite often it comes down to who your investors are, who your stakeholders are. I think sometimes if you get tough stakeholders, they play hardball, they've got good lawyers, you can really get screwed. Whereas the flip side is if you happen to either be smart or lucky, you can get really good, adjustments in terms from your investors, because they have a hell of a lot of power once you have the term sheet and the shareholders agreement in place. Like you really can be stuck between a rock and a hard place. So certainly important to try and get the best investors you can that are going to back you, that are going to work through situations in a fair way. I'm going to come to a slide later, but sometimes it takes 4 or 5 rounds to get to your Series A, and so cap tables can look pretty cooked at that point. And it can be necessary to have discussions with investors.
Yeah, but in this case, he could have potentially avoided being the only one of the co-founding teams that got diluted. So in the movie and in real life, his original stake was about 30% and it went down to 0.03%. So yeah, he should have had his own lawyer. He could have actually shared the dilution love with his other co-founders if he had actually gone about, modeling it. And this scene actually highlights, the ever-changing beast that is the cap table, and how important it is really to model various scenarios with investors coming in, and what that means for you as your ownership as a founder and a co-founder, and even just an early investor. And I think the whole point of this exercise is to make you a better negotiator with investors, but also help you make the right funding decisions for your business and ultimately protect yourself upon exit.
Yeah, there's all sorts of non-dilution clauses that are being added into documents, and good example is the one you've picked.
Yeah.
It was a high-profile case this week in Australia where a founder ended up with 0 equity after 1 year. So yeah, be careful, I guess, the terms that you sign and how these things work. Really good point. Thanks, Nan. All right, so we're going to do a little bit more about rules of thumb, things to avoid, general sort of lessons that we've learned to share with you. So if you just jump in along the way with questions or contributions, if you can. So we're talking at the moment today, I guess, about the angels, friends and family, seed and early stage. So really pre-seed to Series B. That's sort of what this discussion is about. I think once it gets later than that, it really is a much more, I guess, it's a slightly more complex beast. But a lot of these concepts do still hold true. So what about day one? Quite often we see companies set up with 100 shares. I don't know how that happens, but you can't run a raise or have an Esop with 100 shares. So if you're very early stage, or if you set that up, go get your share split done. You want about 1 million shares. So just because you can't issue a fraction of a share or a fraction of an option, right? So if you want to, sell 1% of your company, or if you want to sell 0.5% of your company, you can't do it with, with 100 shares. Or if you want to issue $10,000 worth of options to an employee and your company's worth $5 million, you can't do that with 100 shares. So make sure you have enough shares. Dave, do you want to talk a little bit to the old 50-50 split, mate? I think it's a trick for new players.
Totally. I guess the question is really, when someone comes together, how well do you know them? Because if you're not getting the equity right in the beginning, because you don't know the person, you might start with 50-50. But I've seen lots of examples where people have not stayed in for the journey and have had very poor clauses about dealing with buybacks or winding up that dead weight on the cap table. And if that happens, it can really, you've probably heard the expression blow up your cap table. Easily done. So working out what's fair, and before anyone says, oh, I wouldn't want my shares to vest, you can very easily be on the other side of that too. So, and you can see in the Zuckerberg example where his didn't dilute, others do. It's important that you understand the impacts of all of the terms that you've agreed to, and have that downside protection for yourself if you at least can for yourself. On
that, Dave, just from a founder perspective, it feels really weird to have your own shares vesting in your own company. And then the weirdest thing is, we did it in the beginning, Kim and I, because we wanted a rule book just in case something went wrong. Like we just met each other, we were very well aligned, but we didn't really know, and there's so many reasons why people want to leave a company, and the vesting schedule is just a nice, clean way to understand how to go your separate ways. And without it, you can end up in court, have your whole company essentially destroyed, all the IP locked up, forever. And if companies wreck, it happens all the time. So it's probably one of the biggest risks in the first couple of years.
And then a bit of a prenup, Jace, because people go,
it is.
What will go wrong? I don't want to say that about my friend.
How many times have you seen it when you're advising early stage companies? Like just constant, right? So yeah, and and then you're probably going to have them revested anyway at some point, whether it be your seed or your Series A. Investors are going to want to revest your shares that have already vested, which also feels terrible. But when you try and understand that concept, the investors are largely backing you, the founders, to execute on your vision and mission, right? So they don't want you to be leaving with your shares. So it's kind of fair. You do need to get used to it. This is my main point there.
Be issuing new shares via a split versus anything else, because you can quite easily trigger tax liabilities without doing it in the right sequence as well.
Yeah, that was a question. So you definitely wouldn't issue new shares to increase the number of shares. You would definitely do a split. It's a much better and cleaner way to do it.
Yeah.
Cool. And then bootstrapping versus pre-seed. We definitely talked a little bit about this, but should we just cover this again a little bit, Dave and Nan, any opinions on that one?
Just a quick one, Jace. Look, obviously it's getting the cap table integrating with your revenue model, or where you're at with your product stage, or where you're at to work out what's your cost of capital and how fast you should be going and how much you should be raising, because there's never a more expensive time to raise money than at the beginning. So thinking about that resource management is a key function of saying, and being realistic about what you need, because you don't want to have a ticking time bomb saying we're running out of money, particularly with something like a convertible note. But at least if you get the way your business looks from a resource, both cash and people perspective, you can make a much better decision if that third element is looking at how you're diluting or losing control of your company on the cap table. So having that is something that you just have to get familiar with.
Yeah, I've heard from like major VCs, bootstrapping to $1 million in ARR is the ultimate, right? Super, super hard to achieve because most tech companies require capital to get going, and that's got to come from somewhere. But look, that's nirvana. And then, certainly any funding that you really need along the way, you'd rather have your company going than not, right?
Yeah.
Just a real quick one here about dilution, especially for the earlier stage founders on here, the ones that are not so mathematical. The whole concept is, when you're a seed stage company, you've got 30% as a founder, and the post-money valuation is $5 million, right? So you've got $1.5 million worth of equity. You get diluted over time by the Esop and the investors coming in. So the investors go from 20% to 68%, which can feel bad, right? You're getting diluted and diluted and diluted. But if you have a look at the 12% that you end up owning on the right-hand side at Series C, 12% of a $100 million post-money valuation company is $12 million. So you've turned $1.5 million worth of equity into $12 million in 4 or 5 years. And, under most circumstances, the founder is going to be really, really happy with that. Now, of course, these percentages can be plus or minus depending on your circumstance. You may be a solo founder. You may have 3 founders. You might get diluted more or less along the way. But I think this concept of, value creation, having a small piece of a big cake, is something that we all need to get around. All right, so just talk about typical rounds. So there's a few tricks and traps with these typical rounds, and they do change from year to year. And, you know, sometimes people can skip rounds and so on and so forth. But I just wanted to talk a little bit about this. And I think Dave and Nan will probably both have opinions and thoughts on this as well. But one of the things I want to bring up is there is a market out there. When you go out to raise capital, investors are sort of roughly trying to put you into one of these buckets, right? And it doesn't necessarily have to have the name on the top. But it's like, you know, what milestones have you hit? Where's your product at? Where's your revenue at? Where are your partnerships at? They're trying to put you in one of these buckets. And then the valuation, the percentage dilution, you know, the amount you can raise and where your Esop needs to be. These things are all reasonably standardized, and you should try and understand that there's a market out there. If you can, it makes it easier for investors to look at you, to, you know, to understand your cap table and therefore invest. So I think that's one thing, you know, that you can bear in mind. A couple of other things to point out here. I've got like seed 2 and pre-series A up here, and that is no joke. Like, it can really take some time to get to series A these days. And, you know, the series A milestones are getting harder and harder to achieve. You know, it's like, you know, 3-5 million US ARR now here in the US to run a series A. It used to be a lot lower. So I guess just bear in mind, you know, the capital raising speed that you need to go on, how much capital your company needs to progress, and also the amount of dilution that you're going to cop for that. I've got a little summary on how the dilution can work if you really do need to do, you know, 4 rounds before you get to your series A. Just be careful of that and model that out. Like, this is a modeling session. So you can actually model that out. You know, if I'm diluted 10% for pre-seed, 10% for seed, and I do have a seed 2, and that's 15%, and then I do my series A, and that's 20%, you know, and I've got 15-20% of ESOP over that whole period as well. How much of the company or the founder is going to end up with? And it is important that you understand that and you can model that. Any other comments on this slide, Nan or Dave?
Pretty clear, mate.
Yeah, I just wanted to add with Series A, we're seeing in the local ecosystem monster raises, even at the seed round. Like, I mean, I think Mr. Yum, there was Linktree, and these are like 100 million type Series A rounds. So how are these guys thinking about dilution? They're just raising at a really big valuation very early on before they even, you know, hit some traction.
I've been doing some research on that because it was crazy to me as well. So there's normally some very outlying factors associated with these companies. So their revenue increases extremely quickly. Normally they haven't raised a lot of money prior, so they've got a lot of space on the cap table as well. So they're happy to do a bigger dilution round all in one go. So quite often it might be like a spin out. Like Linktree is a bit of a different one because I think they've got the fastest growth of any company, like except for maybe TikTok in the history of the world. So, and I think Mr. Yum's kind of the same. So there's these 1 in a decade companies that come out, or, you know, once a year companies that come out and get these ballistic vals. But I think, you know, we should sort of just treat them as outliers and not factor them in unless you've just have the most ridiculous growth stats that you've ever seen. Like, you're talking to your other founder mates and they're like, dude, what? You know, otherwise just don't think like that. Like, it's really, you know, 20, 30, 40 times revenue for a really, really good, fast growing SaaS business. You should probably be thinking in that space, as long as really everything's going well for you and you've got good investors and all that stuff. That's how I look at it anyway. But it's hard to try and understand.
Some of them haven't got products, some of them haven't got revenue. But it's almost like they're not buying the company, they're just buying that team because they've delivered before, and they are, you know, I mean, no two ways about it. The better quality the team at articulating what they're doing and how they're going to do it, that moves the needle on valuation. So if it's 100 or it's 30, I've spoken to founders that are going in with 30 million, they haven't built anything yet.
I love that. That's true too.
They won.
And spin outs as well, like spin outs from bigger organizations as well. They really skew these valuations, and you go and look and it's like a team of people have come out of some other, you know, massive group. And so it's not really apples with apples versus like a regular founding team or startup or whatever.
Believability.
Cool. All right. Well, we'll tick along. So here we go. A little bit more about goals, right? So how do you try and get, like, you know, you can maybe set your own goal. I've heard 60%. I think 50% is kind of fair. you can end up with 20 or 30%, 40% and still be really happy, like down the bottom. If you've got 20, 30, 40% of a, $20, $50 million company, that can quite often be a huge amount of wealth creation, for several years' work, right? So don't feel bad if you've been diluted, or if you do get diluted, sometimes that happens. But the goal is to try and, maintain as much equity for the founders as you can, while being fair to investors, in my opinion. So, here's an example. So this company does pre-seed, seed, and seed 2. Each round, dilutes around 20%. I think it's 18 to 23% seems to be the average from the research I've done. Plus your ESOP's going to dilute 10 to 20% as well during that period, depending on how generous you are and how many people you have. So you need to think through also, as Dave mentioned a few times, how much capital your company needs to grow. So always doing an 18-month to 2-year forecast, really understanding how much capital you need, trying to raise that amount of money, and then minimizing the amount of dilution that you take on. So in this case, you start off with 100 as founders, 15% will go to the ESOP, so you're back to 85, and then you do a pre-seed, and then you do your seed, which is only, sort of 10% in this case, or a bit less even, because I did round numbers, and then you do your Series A, so you end up, around the 50% mark. So, just wanted to sort of really spell it out for people how it sort of comes down. Just say, for example, you do your seed and then you don't quite get there, you do a seed plus, right? And then you have another 15%. Like, these things happen. So it's just important to know what you're in for and try and mitigate and plan for those things as best you can. Safes and condos, there's been a few questions about that. I've got a slide here for it. With Dave, you're an expert at these as well. We ran a session on this in December together. We've done a blog on this recently on our blog. Maybe Gabby can put that blog in the chat for people that want to check that out. Like, safes are great in some ways, because they're cheaper and faster to execute. They don't require as much legal fees. Quite often the valuation, can be kicked down the road. Although quite often these days I see, the valuation cap, investors try and put the cap on you, so you're kind of getting quasi-valuation anyway, but you're not locking it in. And then if the next round is at a lower valuation, you actually raise the money at a lower valuation than you could have raised it if you just raised it in equity. So there are some traps with SAFE that you just need to be aware of. I don't know if that was clear. I kind of ran through that pretty quickly, but let's use this example to talk through it. So here we go. We've got a seed round, $1 million raised on a SAFE with a 20% discount and a $7 million cap. So that seems fine. It's around 15% if you go to the cap. But then what about if your next round is, say, 5 million and not 7 million? So you can't hit the milestones that you thought you were going to hit, or there's a market downturn in between and the multiples aren't as high or the valuations aren't as friendly. So then all of a sudden the $1 million goes from 15% to 20%, so it's really chewing into your cap table. But then what happens if the investor turns around and says, oh, I thought it was a pre-money cap and not a post-money cap? And that is something that quite often comes up as a contentious point between founders and investors. And quite often the way it's worded in the SAFE note won't be very clear either. And so there's ambiguity there, which best case scenario, the investors are like, oh, okay, cool, whatever. Worst case scenario, there's argy-bargy there, there's destroyed relationships there. You have to agree to the fact that it was a pre-money. And then all of a sudden it's 1 million over 4 million. So it's 25% dilution. So really important that you just understand that this is possible, understand how much you should raise with a SAFE, and just, if you're not really confident of getting that valuation, don't raise too much with a SAFE, because there's all these downside risks associated with them. Any other comments on that, guys?
Yeah, just I'm not the hugest advocate of SAFEs, because you remember where they came from. They came from Y Combinator. They were taking 100 companies in, and they couldn't possibly do a valuation for 100 companies. That's why they started. So differentiating yourself from the normal is the best way to negotiate your price. And having a priced round is not the worst thing. It's probably a better thing in many ways, because if you kick the goal and you are, let's say you've got a pre-money of 3 or on a cap, and your next round's 15, there's an optical anchor at 3 for the next round saying, well, how's it gone up to 15? So I'm not a huge fan of that. Secondly, it's not great for for people that are wanting to get immediate access to Esop. It's not great for the founders in terms of the next price round. And if you need to look at the combination of both the money coming in at the starting point under a safe, plus when it converts, plus that first fully priced round to see what your real cost of capital is. I haven't seen that many examples where people have nailed it.
Awesome. Please put any questions in the chat. That section is now done. We're going to go to a couple of examples. So I'm going to throw over to Mr. Kenney, first of all, to run us through a few spreadsheet slides. We do apologize in advance for the level of content and complexity here, but we are in cap table modeling land and it is unavoidable to some degree. So here we go, Dave, over to you, mate.
Well, the good news is I'm not going to go to each of these lines, but I'm just going to tell you a bit.
Please explain every number on this spreadsheet for us.
I'm not head of audit here, so I'm just going to tell you a story about this company that got off to a great start, and they got a term sheet. You know, they're raising $2 million, and they were able to attract the value at $6 million, and they thought they were really excited. But then they get the nitty gritty, and they actually determine that the $6 million is actually on a, what's this word, fully diluted basis with a 10% option pool. So all of a sudden, the founders have actually, instead of the 6, I'm thinking, hey, great, I've done an 8 million post. I've actually got a $5.4 million valuation technically, because I've got all of the options are coming out of my share. So that's the first thing to point out. So, and then we're really still happy we've got that, and we're down to 65% in terms of our equity by the time on a fully diluted basis. We've got our options, our shares, and our investors that have moved forward. But the good news is we fast forward 12 months to the next slide, and we've kicked some proverbial. We've gone and we've actually tripled in value. We're now sitting up around 18 million pre. And we're pretty excited, and we think, you know, let's go for 6. Let's raise $6 million. We're going pretty well, but we're still chewing away at our option pool. And one of the things that I like about going in at this higher figure, rather than the low figures, is that I can spread my options further, but I've still got to be super careful about how I allocate how many options to people. But at least on the face of it, having a larger pool of a larger capital base lets me spread my use of options over a further period of time. So at that point, I need to start thinking about, hang on, I'm getting close now to my equity position where I've got 3 different stakeholders. I've got my founding team, I've got my investors, and my option holders. So by the second round, I need to start thinking about how much have I got now. So at this point, I go through to the next round, and I've got I've done really well, and now I've got my third round. I've come in at 60, and I'm going to raise another large chunk, raising $5 million bucks, and I'm now down around in terms of my equity positions. I'm significantly reduced by this third round. I can't see because of my face is over that side. Look at my numbers. So
is that 50.9?
Yeah, 50.9. So I'm hanging on here, but technically, what happens when those options vest? Because those options haven't yet been purchased yet. So once those options vest and can be purchased, they're now voting as well. And separately, if I take away those option holders, if they haven't invested, technically, I'm already under 50%. So my investors have actually, in this scenario, they have got a higher percentage than the founders do now. So at that
just quickly there as a founder, right? So as the company progresses, you can start to pay yourself options. Like you can't have them in the, sometimes you can't have them in a special tax rules option plan, but you can, as you progress, you can start having separate pools for founder options to try and balance out some of this dilution and reward the founders for the huge amount of heavy lifting, that they do. So just bear that in mind as a separate side note for all the founders on the call.
Yeah, so it's not to go into the nitty gritty of this, but it's just some of the watch outs for. So as awesome. you think you're going really well, you're at $60 million at a pre-money valuation in 3 years, but you now have underneath, you have less than 50% of your your company, which technically means you have a falling out with one founder or the investors, you have a little bit of an issue. So reality is that something I want to highlight. As founders, options vest, you need to think about, do you let them exercise as well? Because then they become voting. As Jason pointed out, that the other thing too, that you can always top yourself up, but as a founder, you're not going to be eligible for the startup concessions, but you might use instead a loan plan to have some more shares given to you. Query on whether or not there'll be any additional voting rights, and again, that'll come down to whether the shares that are issued with the debt have voting rights yet or they don't. So
on the founder options as well, you can have the exercise price out of the money, so higher than the last valuation of the company is the advice that we had. So you can still achieve more equity, but you're not really gaining value until you increase the value of the company, right? So there's another way to do it there.
So yeah, so the point is, you've kicked the goal, but within 3 years, you've got to be super careful. And that's why you've got to learn how to use these tools to be able to control how much equity you have. If you have a down round at the next point, where you've got some great revenue, you have a down round, as you start to see some of these term sheets coming in, they're going to be asking for liquidation preferences, etc. And that's where down rounds, essentially, as Nan mentioned before, ratchet clauses that can mean that the new money can get more shares and further increase your dilution. And as soon as you get that down round, you've got to be, that's why the speed and the direction and the increments of your capital raise and the issuing of options and keeping your investors aligned to the decisions and directions that you're going are super important. And this is like a secret weapon, being able to use a cap table well, so that you can manipulate your cost of people and cost of financial capital in a way that lets you run your business like you're in control. So
yeah, I mean, it's the difference between controlling your own company or not. It's the difference between having your own company sold out from underneath you or not. These sorts of things really can happen. So really, really important that you're across this stuff. I know Nan is an absolute expert. Anything to add on any of that, Nan? Sorry, I've been keeping you a bit quiet there for a bit. What's your thoughts on all that?
No, I'm just reading the great questions coming through. Yeah, this is an excellent piece of analysis that anybody should start running just to see the kind of dilution. So I think that's something that you guys go away and start doing very soon.
Any questions there sticking out? We've got, what do you mean by voting? I think voting is about like a member's resolution normally, right, Dave?
Yeah, so only shareholders can vote, and if you don't have 50% of the company, you may not be in control. Not if you require certain things to have a special resolution, meaning you have 75% of the vote, that was already gone at raise one. You were down to 65%. So you've got to be very careful.
You need to canvass your other investors, right? So you've got your two founders might have certain percentage, and then you'll have some angels, and then you'll have your VCs. So you're always trying to understand the balance of what consortium owns 50, what consortium owns 75, things like that. Quite important to be aware of.
Yeah, it's just aligning your investors with the journey you're going on so that they want to keep backing you. That's so important to, those board updates, those shareholder updates, etc., are absolutely critical, so that there's no doubt that you're the right CEO still as you're going through these iterations.
You don't want to be kicked out as CEO. It does happen, and sometimes it does need to happen as well. But anyway, we won't get into that.
In an ideal world, you get to a large number and you say, I'm no longer the right CEO, but you don't want to have that choice made for you.
Absolutely. Absolutely. All right. So this is just a raise example. I'll be pretty quick with this because we've got a little bit on ESOPs to go, and we want to make sure we've got time to run back over the questions and get through those. So, here's an example where this company is raising $500,000. There's an option pool in place. There's also $500,000 worth of convertible notes as well that need to convert into this round as well. So on the bottom section down there, you've got earlier rounds, earlier investors, founders 1, 2, 3, and you've got your residual option pool. So the idea is, in that current position, you need to articulate, you need to accurately record all the capital that's been issued to date, and you need to record whether it's ordinary or preference or a note or a SAFE or an option. So that's a snapshot of where you are now. You don't want to leave anything out of that. If you show this to an investor and they look at it and they see gaps, they're going to immediately run, unless of course you're a total newbie, and you might get away with it, especially if you've been upfront about your experience, and that's okay too, because some investors are happy to help, right? But you definitely don't want to make mistakes with this stuff. You want to make sure that this is in sync with the regulator in your country too. So in Australia, we're going to be ASIC, UK, Companies House or whatever. You don't want gaps there. You want this to be reconciled. You want all the documents to be in your data room, so it's easy to check with the investor as well. So then you've got the new issue. So in this case, you've got $500,000 worth of shares being issued, plus you've got the loan conversion. So the loan conversion is the convertible note from the prior round, and you can see at the top, it was a 20% discount. So instead of getting the share price of the current round, the new issue of 29 cents, the convertible note comes through at 23 cents. So they get extra shares for that discount. And then the right-hand side is the full cap table after the round. So you've got full snapshot beforehand, you've got the new issuance, and then you got the snapshot after. Really important that you're able to clearly display this to investors before, during, and after the round. And sometimes a little jiggle a bit, right? They might argue about how much you raise or the pre-money val, or there can be negotiation during. So you just edit this as you go along. Cool. So I think now we're going to go talk a little bit about equity plans, because in your cap table, shares, options, notes, safes, there are also warrants. They're we're not going to talk about them too much today, but they can be used in very simple terms. A warrant is an option that's issued by the company, but we don't see them very often. I won't go into them. So we're going to cover how big should my option pool be? How do I know how much to allocate to different people? Managing the actual budget of options, and how to model the equity plan as well. So just a quick one for those out there that are hiring. There's some great reports out there. Kate's got some information on our blog about how much the different roles are getting at the moment, as a percentage versus the fully diluted equity. So in this case, you can see here there was a big increase from 2018 to 2021. That highlights the the really hot candidate-friendly market. Also, tech roles versus non-tech roles. More going to the tech roles there as well. How do you calculate it? So one way to calculate it, it's not the only way, but I think it's probably the easiest way and the fairest way, is to do it based off the remuneration. You have a company-wide policy. So in this case, I don't know what, it's 20% options. So it's probably a more senior role, or it's a quite early stage company. So, they're getting 100K remuneration plus 20% options, which is $20,000. So their total remuneration would be $120,000. Now the $20,000 it's not that $20,000 worth of option value. It's based on the last valuation of the company. If there hasn't been a valuation of the company, you would normally do some sort of reasonable valuation. If you're very early stage, you might use the Berkus method or something like that to come up with a valuation. $1, $2, $3, $4 million or whatever you think it is, and you try and peg it to that. So then, you might have a 3-year vesting period. So 3 times 20,000 is 60,000. So that employee gets $60,000 worth of options over 3 years. And then you're comparing it against, these 3 different example valuations here, $4 million, $2 million, $8 million. And you can see the relative percentages of the fully diluted capital of the company that these options, equate to. So just a, quite simple method. I got a question there. Can you use NTA as a val for the Esop? So 2 valuations that you would use when calculating this sort of thing. Actually, there's multiple. We're a global company now. So depending on your country, there's different ways you have to calculate this, but there's normally, the first one is simple. What is the company worth in the market? Like, what are we raising capital at the last time we raised capital, or the last time we did a valuation? So that's the first type of valuation. And that's normally the valuation that you use for, calculating how many options they're going to get. Now, in some countries, there's also a second valuation that's specific to the tax law. In Australia, we have the NTA calculation for the startup tax concession. It's the second valuation. It's normally much lower. It's sort of calculated on, normally how much cash is in the bank for a startup. So you wouldn't use that in this calculation. You would use the value of the company valuation. I have also seen the option value calculated as the difference between the two as well, and that is a way that you could calculate it too. Another quick question there. How did you get 20% option offer?
Sorry, Jason, just wanted to
please
add to your point around, the NTA valuation. When you're also pricing the exercise price as well for the options, it is valuable to be able to use a lower valuation, especially if you want to keep the exercise price as low as possible instead of using like a market price. The whole point of options really is to allow employees to afford it, and it's to grant them compensation effectively just through another form outside of salary and compensation. So yeah, there are other considerations when you are applying the NTA valuation. So you've just got to see why you're using it and if you're allowed to under startup concession rules.
Absolutely, good point. And we do see people offering the exercise price at market value, at discounts, all the way down to NTA, depending on the circumstances. So thanks for that, man. All right, managing the options budget as well. So another thing you need to do is, first of all, work out how many options you need, and then work out how you're going to spend them, and then how you're going to top them up. So you might go, right, just raised my seed round, I need to hire 5 people. Oh, whoops, my option plan wasn't big enough. That would be a mistake. So before, when you're modeling your cap table for your round, if I can go backwards here, on the current position on the left-hand side, if you've got an option pool there and you've granted all the options, you should increase the value of the option pool in the current position before the round, before you go and raise the money, because investors are not going to want to see you raise their money and then immediately dilute them, right? So do this, this plan before you raise your money. So how many people am I going to hire? What are they going to earn? What percentage are they going to get on top of their pay, if you're calculating it that way? And therefore, how many options am I going to need? Include your advisors as well. It's smart to pay your advisors options to keep them engaged and accountable and build that nice sort of strong, trusted relationship. So in this case, increase the option pool before the round. Work out how many people you're hiring, work out what their salaries are going to be, look at market expectations for options as well. Make sure you're competitive. It is a competitive environment, so understand what's going on out there, what people are getting offered, and how you can attract them into your company, because great people want to be engaged and retained and motivated by being part of the ownership team. It's an awesome way culturally to help grow your company. Include your advisors, of course, and then this budget. So here you can see Nan and myself and Dave have started a startup. I'm the bottle washer. Dave's the cheerleader. We've got God level advisory there with Rain, and we need to hire some people, right? So here we've got ourselves in there. I don't know why. Maybe we're not the founders actually. Just pretend like we're not. And then we've got new hires there, and so we had a total budget down the bottom. The total pool, we had 70,000, and we've allocated 75,000. So we know we've gone over in this instance, and we might need to go back and renegotiate, or we might need to go right back and increase the size of the pool. So increasing the size of the pool is normally a members resolution. You need to have it signed off by the shareholders. Then you make this budget, then you manage the budget, and then once you've spent it all, you get another members resolution signed off to increase the size of the pool for any new hiring that you need to do. So you're sort of constantly increasing the size of the pool, to make sure that you can fit in all the hires that you need to take. Just really quickly, remember that the paperwork aligns to the cap table. This is a big legal and financial thing. It's heavy, but if you get the right information, it's totally doable. So you got the constitution, the shareholders agreement to think about whenever you're dealing with this stuff. When you're raising, you got the subscription agreement and the safe and the note. When you're doing the equity plan, you got the plan rules and the offer letter, and the members resolutions need to happen all the way along. We do have a bunch of free stuff for you. So, use the Cake software. It's free up to 5. It does save you tons of time and money, but I'll leave that totally up to you. This isn't a big sales pitch. Dave and I have made a cap table modeling tool that we're going to share with you. So just email us at hello@cakeequity.com, and Cal and Gabby will be sending you guys an email as well how to contact us. We are offering a free cap table modeling session as well to anyone that's on the call. So make sure you hit us up for that. It'll also help us design the in-app modeling features that we're currently designing and building. So this quarter, we're working on those internally. So they're going to be inside Cake, so you can start to run some of these scenarios and manage your option budget and stuff like that in Cake. There's also a bunch of guides and blogs and stuff on our on the Cake blog. And Nan's provided a couple of sort of like free and open source tools there as well as a DIY cap table. And there's also a really nice example of a HR offer letter. So I just wanted to make sure that we weren't pushing you to Cake too much, and we're giving you some tools there, if you want to DIY it, because we're really here to help you tackle these problems in the best way possible. So those will all be coming out via email, and please do email us at hello@cakeequity, and we'll help you out as well. So also, if you're looking to use Cake, talk to Hall Chadwick, we've got like a couple of 100 partners around Australia, from your VC to your accelerator to your co-working space. Most of them will have a discount code for you, so you might as well find it and use it. Otherwise, I think we're pretty much on time. Maybe we can use the last few minutes for Q&A. Anyone have a Q&A that they saw that a question that they saw that we should try and tackle before we run out of time, or how we going? I must admit, I was struggling. There were so many comments on the way you were fanging along. I was struggling to keep up.
No, that's amazing. So many thank you questions, but we can go Claire now that just asked about share.
Yeah. Share. Is it best to have options come from the founders' shares as they vest? Does that make it easier to add more Esop in each round? Yeah, I do. I think I'm understanding that question. So founders sometimes think that they transfer their shares to employees. I think that's the question. We would normally advise against that 100%. So whenever you're doing a share transfer, you're potentially creating a tax issue, or you are creating a tax issue. You can't transfer an asset without creating a tax problem. There can be rollover relief and stuff like that. And I should say, none of this is tax or financial advice, even though there's accountants on the call. This is general and friendly help. But you wouldn't normally do that. You make a brand new, like every time you're doing a round, it's brand new equity. Every time you're doing a new ESOP, it's brand new options, and then you utilize them that way, almost in 100% of cases. Yeah.
With the one small exception of secondary rounds, which is why if you don't have control and you wait too long, you go, oh, now I'm definitely going to go below the threshold of control. So
totally. If you're doing secondaries, you're doing well, and you should be thinking about them, reasonably often and deleveraging yourself a little bit. But that's a good point. There's a question there about options versus shares. I think it's like 99-1 options versus shares. So I think almost no one's doing share plans in Australia. If you qualify for the startup tax concession, options are definitely the preferred avenue there. I do see founders quite often getting this wrong early on, like issuing equity. And quite often there won't be a shareholders agreement either, so there's no way to get it back. They issue like 2%, 5%, 10% equity to some random person that's helping them in the beginning, and then it's like such a noose around their neck. Like, make sure you use the option plan. If they don't deliver value, you can just take the options back. Of course, do it in a fair way, but you really need to protect your cap table in that way, and ESOPs are wonderful for that.
I'm not a tax accountant, but just wanted to add to Jason's point around that. The other kind of benefit you'd see from this kind of option offering in Australia is the tax implications as well. So, you can actually defer your tax implication for employees. In the case of shares, you have to actually pay the tax.
No, what a nightmare. Imagine you gave someone $50,000 worth of options or shares, and then you gave them a $20,000 tax bill that they can't afford to pay. And with the tax office, you can't go back and change stuff. Like, that's the worst thing about tax. You got to get it right first time. Otherwise, they really punish you. It sucks, but it's true. So definitely get this right. Hey, look, one thing I love doing as well is finishing on time. So I'm going to hand back to Gabby maybe just for a little last minute thanks to everyone, and we'll be right on time. So yeah. Gab?
Yeah, thank you everyone. 2:00. Have an amazing day, an amazing rest of the week, wherever you are, and stay strong. Startups are everything, and we're so passionate about. Cake is always here for help you guys. So thank you so much for today, and a lot to come. So keep eye on it.
Fully. Wicked.
Thanks, guys.
Thank you, David. Thank you, Dan.
Thanks.
Bye bye.
Thanks, Cal, too.
Thanks, Carl.
Bye.